Algorithmic trading is the process of using computer programs to execute trading strategies based on predefined rules and market data. Algorithmic traders aim to exploit market inefficiencies and generate consistent profits with minimal human intervention. To be a successful algorithmic trader, one needs to have a combination of skills, knowledge and tools. Here are some steps to follow, along with some examples of each. Learn the basics of financial markets, trading and risk management. You should have a solid understanding of how different asset classes, instruments and markets work, as well as the factors that affect their prices and movements. For example, you should know how stocks, bonds, currencies, commodities and derivatives are traded, and what influences their supply and demand. You should also be familiar with the concepts of risk, return, volatility, diversification and portfolio optimization. For example, you should know how to measure and manage your exposure to different types of risk, such as market risk, credit risk, liquidity risk and operational risk. You should also know how to optimize your portfolio allocation and performance using tools such as the Sharpe ratio, the efficient frontier and the capital asset pricing model. Choose a programming language and a trading platform. You should be proficient in at least one programming language that is suitable for algorithmic trading, such as Python, R, C++, Java or MATLAB. For example, you should be able to write code that can collect, process and analyze data, implement trading logic and algorithms, and interact with APIs and databases. You should also select a trading platform that offers access to historical and real-time market data, backtesting and execution capabilities, and supports your chosen programming language. Some examples of popular trading platforms are MetaTrader, NinjaTrader, Quantopian and TradingView. For example, you can use MetaTrader to trade Forex and CFDs using the MQL4 or MQL5 programming languages, or you can use Quantopian to develop and test your strategies using Python and trade them on various brokers. Develop and test your trading strategies. You should have a clear idea of what kind of trading strategies you want to implement, such as trend following, mean reversion, arbitrage, market making or high-frequency trading. For example, you can use a trend-following strategy to identify and follow the direction of the dominant market trend using indicators such as moving averages or trend lines. You can also use a mean reversion strategy to exploit deviations from the average price or value of an asset using indicators such as Bollinger Bands or RSI. You should also define your entry and exit rules, risk parameters, performance metrics and evaluation criteria. For example, you should specify when to open and close a position based on signals from your indicators or other conditions. You should also set your stop loss and take profit levels to limit your losses and lock in your profits. You should also define how you will measure and evaluate your strategy's performance using metrics such as return on investment, ROI, maximum drawdown, MDD, win rate, WR, or profit factor, PF. You should then use historical data to backtest your strategies and analyze their results. For example, you can use the strategy tester in MetaTrader or the backtester in Quantopian to run simulations of your strategies on past data and generate reports on their performance. You should also use simulated or paper trading to test your strategies in real-time market conditions before going live. For example, you can use a demo account in MetaTrader or the paper trading mode in Quantopian to trade with virtual money and see how your strategies perform in live markets. Optimize and refine your trading strategies. You should constantly monitor your trading performance and look for ways to improve your strategies. For example, you can use the optimizer in MetaTrader or the alphalins in Quantopian to fine-tune your strategy parameters and find the optimal values that maximize your performance. You should also keep up with the latest market developments, research and innovations in algorithmic trading. For example, you can read books, blogs, journals or newsletters on algorithmic trading topics such as machine learning, artificial intelligence or natural language processing. You should be ready to adapt your strategies to changing market conditions and opportunities. For example, you can modify your indicators, rules or parameters to account for new trends, patterns or events in the market. You should also conduct regular reviews and audits of your trading systems and processes to ensure their reliability and security. For example, you can check your code for errors or bugs, update your data sources or libraries, or test your network connectivity or latency. Scale up and diversify your trading portfolio. Once you have established a track record of consistent profitability, you can consider scaling up your trading capital and diversifying your trading portfolio. For example, you can increase your position size or leverage to amplify your returns or reduce your risk per trade. You can also explore new markets, instruments and strategies to increase your exposure and returns. For example, you can trade different asset classes, such as equities, futures or options, or use different strategies, such as arbitrage, market making or high-frequency trading. However, you should always be aware of the risks involved in algorithmic trading and manage them accordingly. You should also follow ethical and legal standards and regulations in your trading activities. For example, you should avoid market manipulation, insider trading or front-running, and comply with the rules and requirements of your brokers, exchanges or regulators. Thanks for watching, and until next time, happy investing! If you enjoyed this video, please hit the like button and subscribe to my channel for more content like this.